Welcome to the Explainer. We have a absolutely massive story to unpack today. Salesforce just dropped their biggest earnings beat in over a year, and the market reacted with total ferocity, sending the stock shooting up 13% in after-hours trading. I mean, if you were watching the ticker, it looked like a complete and total triumph. But, as we always do around here, we need to look beneath the surface. We're going to break down exactly what drove this surge and separate the actual, real organic growth from the headline hype. Okay, let's dive into this, because really, this is the million-dollar, or I should say, multi-billion-dollar question. Is this massive 13% pop a genuine foundational turnaround for Salesforce? Or is it just an illusion driven by a one-time accounting trick? To figure out if this rally actually has legs, we need to peel back the layers of this earnings report line by line.
Part 1, the blowout quarter illusion. Let's start by looking at exactly what Wall Street saw in those first few frantic minutes after the closing bell. On the surface, the stats are phenomenal. Q2 revenue came in at $11.35 billion, edging past the $11.33 billion estimates. Not bad at all, right? But then, look at the net profit. It surged a staggering 87% year over year, hitting $3.53 billion. And to top the whole thing off, management raised their full-year revenue outlook to over $46 billion. If you just skim the summary, you'd think Salesforce was literally printing money from its core software sales.
And then, the algorithms caught hold of this number right here, 590. This was their reported adjusted earnings per share. Now, put this into perspective. Wall Street analysts were expecting 327. They didn't just beat estimates, they completely obliterated them by nearly double. When a mega-cap tech stock drops a 590 EPS against a 327 expectation, a 13% stock surge makes total sense.
But hold on a second. What happens when we look at this alternative number, $3.37? When you actually dig into the fine print of the financial filings and strip away a very specific non-operational windfall, the true operational adjusted EPS drops all the way down to $3.37. Now, to be fair, $3.37 is still a beat on the $3.27 estimate, but it's certainly not the earth-shattering home run that the headline 590 suggested.
Which brings us to Section 2, the Anthropic elephant. So you're probably wondering, where on earth did that massive discrepancy come from? How do you just magically generate over $2.5 billion in profit? Well, here is your smoking gun. $2.6 billion of that massive EPS beat came from a non-cash gain based on Salesforce's strategic investment in Anthropic, the AI company famous for the Claude chatbot. Because Anthropic's private valuation skyrocketed, accounting rules say Salesforce gets to mark up the value of their investment. They got a massive paper windfall, and that windfall flowed straight into their net profit numbers for the quarter. And this brilliantly illustrates a really important divide we always have to navigate. On one hand, you have one-time paper gains. That $2.6 billion, it's not recurring revenue. It's not cash generated from selling software subscriptions. It is purely an accounting event. Sure, the market threw a party over it, but paper gains don't pay dividends or fund research and development forever. On the other hand, we have the metric that actually matters, recurring AI integration. We need to know if customers are actually buying Salesforce's AI products month after month.
Let's look at that in Section 3, Enter Claudeforce.
The good news is Salesforce isn't just sitting on a silent investment. They are actively weaponizing this technology in their core platform. They're taking the Claude AI and baking it directly into their CRM with 37 pre-built sales skills. And all of this relies on a concept called Agentic AI. This is a crucial term to understand. Traditional AI, it's conversational. You ask a question, it gives an answer. Agentic AI is a whole different beast. It doesn't just answer, it acts. Imagine a sales rep telling their CRM, hey, pull the latest metrics on the Smith account, draft a follow-up email offering a 10% discount, and log the interaction. The AI takes those independent actions inside the platform data without you doing it manually. It's an absolute game changer for productivity. And let's see how this builds into actual financial momentum. When we look at their specific AI products like Agentforce and Data 360, they aren't just empty buzzwords. They saw annual recurring revenue, or ARR, grow by over 210%, pushing total AI-driven ARR to nearly $3.9 billion. This proves that the Anthropic partnership isn't just a paper gain sitting pretty on a balance sheet. It is driving a very real, very aggressive organic demand signal from enterprise clients who want this agentic AI capability right now.
Moving on to Part 4, the real growth engine.
All right, so we know the AI story has some actual meat on the bone. But what about the rest of the company? Let's zoom out from the flashy AI headlines for a second. If you really want to know the health of a subscription software company, you don't look at EPS, and you don't even look at current revenue. You look at this metric right here, CRPO, or current remaining performance obligations. Busting through all that financial jargon, this simply means booked future revenue. It tells us the value of contracts that have been signed but haven't been billed yet. It's the ultimate indicator that customers are confidently buying new products today, not just passively hitting the auto-renew button.
And the CRPO numbers for Salesforce are incredibly strong. CRPO grew 14% year over year, hitting $33.5 billion. That is accelerating growth in the pipeline. On top of that, their free cash flow jumped an incredible 81% to $1.1 billion. So regardless of the Anthropic accounting trick, this proves beyond a shadow of a doubt that the core underlying cash machine of Salesforce is working flawlessly. Let's check the charts in Section 5, Technicals and Target Price. So the fundamentals are solid, but how does that translate to the market reality? Context is everything, guys. Before this explosive earnings pop, Salesforce was actually down roughly 23% for the year. You really have to understand that this massive rally is a recovery, not a breakout to new all-time highs. And right now, the stock is slamming into a critical technical level, a key resistance zone between 212 and 216, which marks a long-term downtrend line. For this stock to prove it has truly turned a corner, it has to break and hold above this wall.
But if it does break that resistance, the valuation looks incredibly compelling. Salesforce is currently trading at a forward price-to-earnings multiple of just 14x. For a software titan growing top-line revenue at double digits with expanding margins, 14x is historically cheap. The average analyst target is sitting up at $242. And if that AI reacceleration we just talked about proves to be highly durable over time, the bull case target stretches all the way to $315 a share. The upside potential is clearly mapped out.
Which brings us to Section 6, the final verdict. We've seen the headline illusion, we've uncovered the accounting windfall, and we've verified the underlying strength in the pipeline. It's time to bring all of this together. So the crucial point is, we need to stay grounded in reality. The market is clearly buying the AI comeback narrative, but we absolutely cannot ignore the facts. The headline EPS beat was largely a non-cash mirage. Major players like Morgan Stanley are still remaining perfectly neutral on the stock, pointing to cautious feedback from enterprise customers regarding IT budgets right now. And despite the 13% celebration, the stock is still technically in the red for the year. Therefore, the real test isn't what happened yesterday. It's what happens tomorrow. Can Salesforce deliver organic, AI-driven growth without any more accounting help over the next 2 quarters? If they maintain that 14% CRPO growth, this stock is undeniably cheap at a 14x multiple. But if that growth slips and the Anthropic magic fades out, today's massive pop might just be a short-lived blip in a longer downtrend. The data is out there, the accounting is clear, and the AI product demand is surging. So I leave this entirely up to you. Based on those accelerating CRPO metrics and the reality of their agentic AI attach rates, what is your move? Are you buying the breakout, selling the accounting balance, or just waiting for the dust to settle? Let's keep watching this space.